Good morning, good morning. It's Friday the 6th. This is what we're talking about this morning. Tech has been hit hard again. Amazon's big spending plans just adding to the angst. Silver's had a really wild night over in Asia. We'll get to that in a minute. And Bitcoin bouncing off 60,000. It's down, though, 50% since October. Michael Saylor's strategy hits the rocks with a $12.4 billion Q4 loss, Anna.
Let's put some of that together and show you where we are in terms of equity market futures right now for Europe and for the United States. Europe is really doing its best to try and bounce. We've seen a huge amount of volatility through the Asia session. A lot of those popular trades being reversed over the past few sessions or so. The S&P down for 3 days. So the emphasis is still on the negativity, on the risk off. But we are seeing an effort to try and bounce. Nasdaq futures actually off their earlier lows as well. Down 0.5%, but they were down by more than that earlier on. And to Guy's point around Bitcoin, we are trying to bounce there as well, up by 2.7% right now as we come through the Asia session into Europe. But we have seen Bitcoin lose 50% of its value, so we'll certainly talk more about that through the programme. The countdown to the opening trade starts right now.
Good morning, happy Friday. Let's start on tech once again this week. And I'll start with some numbers because it is again about CapEx. Let me remind you, in terms of the CapEx spend promises from Microsoft, $105 billion for this year. Meta, $135 billion this year. Alphabet, $185 billion this year.
You've remembered all these, well done.
Amazon, hold my beer, $200 billion at the top end for 2026. Put it together, $650 billion in potential CapEx spend from 4 tech companies for 2026.
OK, let's put size and scope here, because I did some research this morning. The German federal budget for 2026, I think, is about $618 billion. The exchange rate, obviously, is changing things a little bit. So they're spending more than Germany, and that is it's just epic.
These are now countries up 60% year on year as well from these 4 tech names, as you've set out, Tom. That is the extent of the uplift that we're seeing in CapEx. And there are still questions about whether it's going to be all worth it, essentially, aren't there? And that's what the market seems to be increasingly antsy about, and that has weighed on the Amazon share price.
If you're looking for some kind of reassurance, it's the backlog in demand that you're starting to see, not just Microsoft, but Amazon as well. Close to $250 billion that they say has still to be delivered in terms of the demand picture. But this is a bet on winner takes all. And again, no one wants to be losing out.
So I'm a bit confused about what's happening out there at the moment. So there's 2 stories that are unfolding, one of which is the massive CapEx spend, and the other one is what is happening with the software stocks, OK? So let's take the software stocks first. The software stocks are down because we're worried that AI is going to work.
Yes.
OK?
I know where this is going.
The big tech stocks are down because it's going to cost too much to get there. Is that kind of where we are at this point?
Yeah.
Because
do they fit together?
There's 2 different narratives here, and I'm trying to work out if they do fit together.
Well, yeah, I mean, it does seem they sort of almost can. We seem to be able to worry about both of those things at the same time, but we do seem to have lost sight of some of the hope around this, I suppose, or what it's all for. And that takes us to the software side. Anthropic out with another of their exciting new releases. Remember what it did to some of the legal services.
Second
in a week. They keep them coming. This one is actually named Claude Opus 4.6. It's for financial research, so this is going to be relevant to our audience.
Pay attention.
Analysts pay attention. I was looking at what it does. Scrutinises company data, filings, and the market. It also can do some spreadsheets and some presentation. Does that do more than the things that are out there? I don't know. We'll have to wait and see. But it does seem that all this week, markets have been selling first, asking questions later. We really have lost sight of that sort of symbiotic argument between software as a service and AI.
OpenAI and Anthropic are now pre-IPO companies, and they are getting match fit for that IPO, and they're trying to prove that they can monetize this technology. So this volatility is going to continue because more releases will be coming from both of those companies through this year as they lead up to those IPOs, and the question marks will continue in terms of how they push up through these verticals to show that they can actually make money on these massive investments.
Let's talk about some of the other market themes, because we've got tech, we've got Bitcoin, we'll come to that in a moment. But some of these popular trades, things that have been popular that we've talked about a lot, whether it's tech, software, AI data centers, whether it's gold, whether it's crypto, they've just fallen out of favour, it seems. And that seems to be the dynamic of this week. And there doesn't seem to be one uniting narrative. We talked about this yesterday. We've seen the S&P down for 3 days on that sort of jittery environment. Metals is very much part of it. You've talked about, the volatility through Asia on the metals side has been incredible. Silver was down at 10% at one point. I'm now looking at my screen. It's up 1 or 2. This is the kind of volatility we're getting used to on a daily basis.
Silver's in particular is having a really wild ride here. and I don't know if you can make sense of it. I keep reading notes, trying to understand what is happening and trying to get a kind of through theme that gives me some guidance as to what happened, and I can't find it because the 10% swings on a daily basis.
Such a small market.
It's that's the only. So that is the only conclusion you can come to is basically there's a lack of liquidity. You're getting huge volatility. But I don't know where the signal is beyond that.
Yeah.
We've talked about Chinese buyers. So Chinese buyers, open interest on Shanghai futures contracts falling to the lowest level in a year. So you need the Chinese buyers to come back in. We talked about the volatility around silver, but there's volatility around gold, less so. But if gold is at the most volatile level it's been in decades, how much of a hedge does gold play longer term? There's still a bet on this. PIMCO thinks that longer term gold's going to play that role. But it is a much more volatile asset than we had assumed just a few months ago.
One thing that I found really interesting yesterday is actually Treasury's played a bit of a safe haven role, which is not something we've seen.
So this is the dollar. This is the dollar story as well.
Yeah.
So the dollar's coming back as the dollar looks like it's playing the right role again.
Yes, traditional.
And Treasuries are doing that again as well.
We need to hear from Walsh, and we need to get some data, and we'll get certainly the data next week.
A little bit later. Let's talk about Bitcoin and what is happening there. It looks like it's bounced off 60. What was it? You had 64 over there just a minute ago, something around there. So we've bounced off the 60 level, which looks like a kind of key line in the sand for the time being. But is October now the high for everything? Was last October the kind of the market's peak in October? Bitcoin certainly did.
124 in October.
Yeah, it's down by 50%. So it's been absolutely battered since then. Strategy out with its numbers last night. Michael Saylor's sticking to kind of the narrative going forward. $12.4 billion loss though.
Mark to market, that'll hurt.
That's precisely. That is. And that company is basically a high beta proxy on what the Bitcoin trade is. Can it hold 60? Now there's this other theme which is beginning to emerge as well. You've been talking about quantum this week. Is Bitcoin old technology? If quantum comes through, could the algorithm be cracked? And would it become therefore worthless in that kind of scenario? These are the things that people are beginning to talk to. Bitcoin's beginning to feel a little old and long in the tooth.
Do you know what? We've got a whole episode on quantum computing on Bloomberg Technology next Friday, so that's a nice little
very well timed
to the show ahead. So we'll ask that question.
Can quantum crack Bitcoin?
That is the longer-term question, a longer-term question for Bitcoin. The here and now as well is how many leverage bets, more leverage bets are going to be
cleaned out.
And what does that mean? What are the then connections to your point yesterday to the broader markets around the unwound?
Is there anything systemic around what we're seeing in Bitcoin? Is Bitcoin to blame for any of the volatility in other markets? Michael Burry, we were so busy yesterday we didn't get to talk about this much, but Michael Burry has been making this argument that this is going to be systemic, that this is going to feed into other financial services businesses and weigh on sentiment. Others disagree, say it's not so integrated.
I've definitely seen both sides of the argument, saying that actually it's reasonably ring-fenced. Actually, there isn't that much spillover happening here. That, to your point, that actually it is a single story rather than a systemic story. I don't know. We'll kind of watch out, but it does feel as if we've got a series. If they're not correlated, we've got a series of big volatility events coming through all at the same time, and that feels to me like there could be some connections.
Let's get to Orsted, as we're thinking about wind today, which will become clear later when we tell you the guests we have on the programme. We've got Orsted coming through with their guidance and their numbers. The Q4 revenue looks to be better than expected. The full-year revenue looks to be slightly better than expected. There is an EBIT loss. It isn't. And it is worse than expected, it seems. So an EBIT loss of 1.04 billion Danish kroner against an estimate of a profit of 1.3 billion. And there's an impairment charge in the fourth quarter. But they are maintaining their 2026 EBITDA guidance. So
have you seen Stellantis is taking a huge charge? Stellantis is taking a charge of around 22 billion euros in the second half of 2025 as it looks to reset the business away from EV. There's also the BYD story, which is out there as well, which is certainly a story out in the Chinese market in kind of substantial fashion. But it looks like, therefore, we are seeing a second half preliminary net loss for Stellantis of 19 to 21 billion euros on the back of this charge.
So this charge includes a cash payment as well. So it isn't just all some sort of accounting activity. There's a cash payment as part of that, which is 6.5 billion. So we will keep that in focus as we move closer towards the open. And actually, auto stocks have been quite volatile this week. We've had some numbers out from some places which have been negative. Some of the smaller car makers out with some numbers that have weighed on the sector. That followed a day where the sector did actually quite well. well. So on the back of FX moves, I think. So we'll certainly keep an eye on that. Taking charges of about 22 billion on this EV reset.
LG is ending its joint venture with Stellantis. I'm assuming that's the battery story.
Yeah. They're scrapping the dividend and they're authorising as well an issuance of 5 billion euros of bonds. So more corporate issuance in terms of debt. That has been authorised by the Stellantis board. BYD, as you say, very interesting as well, and particularly in terms of the domestic market, and a reminder that the consumer in China remains very squeezed. Let's get to the broader banking space with a focus on Spain and Europe as well, and get Sabadell, because the latest lines coming through from Sabadell in terms of the numbers, essentially in line with estimates. So fourth quarter net income coming in at 386 million euros, just slightly above the estimates. Net interest income for the fourth quarter also essentially bang in line with the estimates, confirming Sabadell, Banco de Sabadell, the 2025-27 strategic plan targets. Very pleased to say we can bring in the CEO now of that bank exclusively, César González-Bueno. César, good morning. My first question to you, though, is, given your success in fending off the takeover bid by BBVA, why are you stepping down?
Well, I came here when I was already retired. The challenge... No, I was retired and enjoying a good life. And the challenge of turning around Banco Sabadell was so tempting, and I'm so thankful of having had these phenomenal 5 years of turnaround. Let me tell you, we have multiplied the value, including dividends and share buybacks, by 12 times in the course of 5 years. We are the best performing stock in these 5 years of all the Spanish stocks. We are the first and best performing stock of this period of all the European banks. And we have a phenomenal successor that is ready. I think the time couldn't be better.
What are the priorities for the new leadership on the back of the numbers that we've had out today?
I think it's very clear. I know Marc Armengol, the new guy, and I've fully endorsed the proposal of him becoming the next CEO because he's full of virtues. And he knows the bank upside down, and he has been part of the strategic plan that goes until 27, that will bring us to a return on tangible equity of 16. And he's committed to that, and that's the first commitment that he has for his new endeavor. But at the same time, we have fully digitalized the bank, we have modernized the bank, but there is a next challenge, there's a next opportunity now around AI. Marc is a phenomenal business person, he's a phenomenal team leader, but at the same time he has a spike, which is that he's very good on all the very technical areas. I think AI is not a bluff, it's a real thing. We're underway of transforming the bank also with AI, but he's going to give a spin to that is going to make this phenomenal bank even better.
César, good morning. Thank you so much for joining us. Tell us a bit more about that then, because we've been speaking to lots of bank executives about AI and what it can deliver. Some cast it as quite front and centre. For some, it seems to be just part of their sort of tech plans. How much potential is there to reinvent what you do and how you do it using AI?
It's phenomenal. When you see the case examples and the life examples that we already have, which are yet not fully transformative of the whole operation, you see the potential. It's undoubtful. You see, for example, how an agent, a digital agent, can hold a conversation around serving a client or having a recovery of a small amount, and the metrics are unbelievable in terms of performing the same as humans, and at a much more efficient rate. The number of case users will grow and grow. It's still at the beginning in terms of having real impact on the numbers, but 5 years from now, it's going to be a real transformation.
Okay, and you're talking about investment in AI and what big changes that this can bring for the business under new leadership. At the same time, you've just come from successfully fending off a takeover bid. Are those two things linked, César? Is it going to be a story of investing in AI for the future to ensure a standalone future?
I think it is far more simple than that. I think we have done a phenomenal job in transforming the bank during these 5 years. I think I am ready to move to a bit more enjoyment of life. And I think we have internally the management, all the executive team, the motivation in the bank is at its highest. And it was a good moment to do a transition. On top of that, there is, of course, an AI opportunity. And Mark will first and foremost deliver on the results, but at the same time start a transformation that will be very significant. And it's as simple as that. There's no more complexity in the story.
Cesar, congratulations. I'm very jealous. It sounds amazing.
Retiring twice is quite an achievement.
Retiring not once but twice sounds like
Spain.
Yes.
sounds like a fantastic thing to do, I have to say. You leave the bank as a standalone institution. What does it need to do to remain a standalone institution? Does it need to become bigger? Does it need to deliver M&A of its own? Does it need to become an acquirer? What do you think the strategy should be continuing from here to maintain Sabadell's independence?
I think the course is very clear. We are not yet, but we are in the course of attempting to become the best bank in Spain. And we're not so far in many fronts. And it's about doing more and better of the same in that respect. M&A is not going to happen internally in Spain in the near term. Why? Because there are three very large players that should not be bigger for competitive reasons and competition laws. And all the rest are at this time having a very sweet period with good strategies, with growth, with capital generation, and therefore, unless there is a change in the macro environment, there will be no opportunity for further consolidation. It would make sense, but it's not to be expected in the near future. In a longer term perspective, it would be very much logical that to happen, and of course, Sabadell is the best place to be the consolidator at that time. But it doesn't require it, neither from a defensive nor from an offensive perspective.
Cesar, I'm looking at the data on my Bloomberg screen telling me about the top holders of your stock. David Martinez comes in at number 3. He is looking like he is going to sell down his stake in the bank. Who is going to replace him? Is there a need for another big shareholder like that on the list? Who is it going to be?
As you know, Zurich has a 5% holding of the bank. Is at the same time a phenomenal partner in insurance. We are growing in a fantastic way with a cooperation that, it's an example of how to do a cooperation with an external partner. And they were crucial in the defense of Bank Sabadell because, of course, they didn't tender their shares, which only had a 25% tender and therefore was unsuccessful. They are a core investor. But furthermore, who is our core investor are our retail investors. 40% of our investors are retail. And of that percent, of those, 75% are at the same time clients. And those are the ones who only contributing with 1% to the tender demonstrated that are our core shareholders. They are our clients, they are engaged with us, we serve them with pride, and that's the core.
Cesar, of course, you're selling TSB to Santander. When does that sale close, and what will the final price be?
The final price in the estimate, because of course the proceeds of what is happening between the closing of the sale and the closing belongs to Banco Sabadell, will be around 3.3 billion euros. And the closing will happen in the second quarter. It's going ahead extremely well as planned. I think it was a beautiful transaction both for Sabadell and for Santander, which is always a good thing. We both won.
Cesar, we'll end the conversation with a slightly more sensitive topic. The Spanish media has been reporting about alleged relationships between Sabadell and Jeffrey Epstein, the disgraced financier. Of course, I know that this is a part of the business you have since sold. It was the Miami subsidiary, I understand, and none of the current management of Sabadell had anything to do with that period and that business. That all said, is there anything for you to look into here? Is there any action to take?
Well, there aren't, because we don't even have access to the information. It's very old stuff. There was apparently a loan in the normal course of business, but we do not have access to that information, so nothing to be expected.
So we will leave it there. Thank you very much indeed for your time this morning and all the interviews you've given us over the last 5 years. Please send us a postcard. Cesar González.
Thank you so much.
González-Bueno, the Sabadell CEO. Thank you. I will look forward to that. I wonder where it'll come from. I imagine he's got many places on his list of things to visit. We are going to be joined by the Vontobel CEO very shortly, Henrik Andersen, the Vestas CEO. I can see him. He's literally just walking into the building right now. He'll be on set very, very shortly as well. Madison Fowler, JP Morgan Private Bank Global Investment Strategist, will be joining us as well, as will Anbiti Baghuna, Northern Trust Asset Management Global Co-CIO.
Coming up on the programme, Rio Tinto walks away from the Glencore mega merger. We saw the Glencore share price dropping on that yesterday. We will bring you all of the details behind that latest move in the metals market. Plus, we'll focus on Japan ahead of Sunday's snap election as a BOJ board member adds to signals pointing to interest rate hikes, perhaps. Up next, we will check back in on the markets with more on the AI spending spree and the tech sell-off. Please get in touch with us. IB plus BBTV Go is the function to use. That's on the Bloomberg terminal. It's Friday. This is Bloomberg.
Let's bring in Bloomberg MLive's Venran. Welcome back. Happy Friday, by the way. We're going to get another check on the markets with a particular lens on the central banks. But let's start on the precious metal story. Maybe the two are linked. Ven, good morning. Help us understand what is happening with the price action. Once again, volatility back, most pronounced in silver. Silver and gold both up in the session now, at least up as we look at it now. But, of course, volatile, certainly silver. What do you make of what's going on? Where are we? Are we going to settle out? Are we going to get to a place where there's a bit more comfort in the precious metals?
Morning, Tom. I think that this was an accident waiting to happen. I mean, the way prices had run up in both gold and silver, and particularly silver, was just unfathomable. And many in the Reddit crowd wouldn't have seen this coming because, if you saw the social media, all the posts were about, how silver is headed for the moon and, fundamental misalignment of supply and demand and all that. Well, there is a fundamental supply and demand mismatch in silver, but that doesn't mean that it can keep going higher and higher. And what we have seen over the past week is an abject lesson in the markets is that, when the move gets overextended, it is time for a pullback. But, I'm more optimistic on gold rather than silver in the short term, because I think that, gold has got many virtues going for it, which is that central banks diversifying away from the dollar. You've got central banks that are relatively price inelastic buyers, and the erosion of faith against fiat currencies, all that is playing into gold. Now, even so, I think that, gold can go up to $5,600 an ounce, which was the previous record in a space of 2 to 3 months. But it can go even higher than that in the short term. But what happens after that is a bit of indifferent performance, a portfolio drag, if you will. Yep. Because I did a bit of an analysis, and what it shows is that gold is trading in $20 to $33 already, meaning that it is 8 years ahead of time, 7 to 8 years ahead of time. So I think that there is going to be a bit of consolidation after a push.
Ven, in 20 seconds, which is the biggest problem for the gilt market? What's happening in Westminster or what's happening at the Bank of England?
The bigger problem is the political risk premium guy, because at the long end, if you saw the long end, despite lower inflation forecast, the long end is selling off. So that is a conviction that the markets are fearing the political risk premium.
Ven, great stuff. Thank you very much indeed. More on the markets next. This is Bloomberg. Half an hour to go until the start of the Friday session. We're almost there. Futures look like this. This is the picture in Europe at the moment. You've got most European futures negative. There's a little bit of variance within it as to what we are going to see on the downside. Nasdaq futures are also negative this morning, which is worth paying attention to, down by 0.3. S&P futures are down by 1 to 2, 0.2%. So just a little bit, but we're not bouncing. I think that's the critical thing. Bitcoin has bounced a little bit. where are we now? 64, something like that. 64, 65. So a little bit of a bounce there, but it still feels like quite a rocky start.
Yeah, with that comparison to 124 back in October.
That's the number you need to remember.
We'll be checking gilts, of course, with the open at 8. There was quite a bit of movement in terms of the gilt markets yesterday on the back of the BOE and some political risk premium. But right now, in terms of the sovereign debt of Europe, you're seeing a little bit of a bid for German debt and the debt of France and Italy as well. So German 10-year currently basis point move of around 3 basis point move lower. French OATs at 343. Also lower by about 2 basis points, and BTPs as well. So a little bit of money moving into the sovereign debt of those Eurozone nations at the moment.
It has been a volatile week, plenty of news flow to discuss. On top of that, we have plenty of earnings coming through from the financial services sector. Let's go to those from Vontobel right now. The money manager out with numbers that come in better than expected. Profits at the net level for the full year, certainly. Efficiency project, that's being announced, a plan to cut costs. So we will certainly talk about that. Let's have a conversation about all of this with Vontobel's co-CEO, Christelle Rondu-de-Lint, who joins us now. Christelle, really nice to speak to you today. Your numbers better than expected, it seems, at the full year profit level. So that seems sound. What is the conversation with the client base at the moment? What do clients want to talk to you about, Christelle?
Yeah, just to come back on our results, indeed, a successful year for us at Vontobel. We grew profitability, assets and capital, all while absorbing the macro headwind, so the lower interest rates and the much weaker US dollar. And that's the segue to what our clients want to talk about. They want to talk about how to invest. This is what we do for them. This is how we grow, by the way, investment expertise, not extending our balance sheet. And the conversation is very much centered around diversification and how to diversify one's exposure.
OK, diversification. And clearly you're having some success in attracting some new money. I noticed the new money number for 2025 is the most in 4 years. We've seen the Swiss money management landscape, of course, over that period really shaken up. How is that falling out for you, if you like? All of the chaos created in the immediate aftermath of the collapse of Credit Suisse. How is that building towards new money?
I think the geopolitical environment is one that plays very much into our own strength, or volatility, if you wish, is one that plays into our own strength, where the institution, Vontobel as a whole, stands for stability, a 100-year-old institution. Switzerland remains one of stability as well, institutional stability. And then there's all this discussion that we just already alluded to around diversification, whether it's a sector thing now around, AI and technology, whether it's a currency thing, and in particular around the dollar. And this is one that really plays into our strength, because who are we? We are a stable, solid investment management house, active with experts.
OK, Christelle, let's talk about that diversification trade in a little bit more detail. One of the ways in which a lot of people are trying to diversify has been into private markets. Private markets are now awash with fear about overexposure to the software sector. How concerned do you think your clients should be?
In general, it's a theme that we've approached and broached up with our clients very early on, and this is definitely, you're right to point it out. I think when you invest in let's call it across segments, right, you have to look at your exposure and make sure that you have that look through. So you might not be exposed to a given sector in the public markets, but you might be exposed in the private markets. What you certainly don't want is to pile up the same type of exposure through debt, equities, and then potentially private equity. So I think the concern is not greater that at any point in time, albeit considering the valuation, one might even want to take a closer look. But I think it's just been a long period of time, and I mean by that the quantitative easing period, where you could almost look away. Everything was kind of roaring along, and you're back to basics.
Do you think, if we're going into a new period, do you think the illiquidity premium that private markets bring is a good thing or a bad thing? We are entering, it seems, a period of higher volatility. Your clients, if they're in private markets, have run the risk of being locked in for longer. Is that risk worth taking as you try and deliver that diversification trade?
So it's a defined answer. It's a risk worth taking with the right manager, and if you can afford the illiquidity. So there's not one-size-fits-all clients, basically. But bear in mind that, say, private equity, 80% or 85% of US companies that have a turnover of above 100 million are private. So if you want to get exposure to that segment, which, you know, is a diversification and an additional segment, you've got to go private. But only do it if you can indeed afford to be locked up. And I can't repeat that enough.
Crystal, on the diversification story, how concerned are your clients at all about exposure to the US? Are you seeing any significant repatriation of capital out of the US to other markets?
We're not seeing panic, if that is the question. I think when you look at the relative performance over the last few months now, you are seeing a reallocation, a rebalancing, I'd say, of flows, right? And I'm talking the industry now, not generally ourselves. But you're seeing emerging markets performing well. You see European markets year-to-date performing well. But by the way, you see even intra-US market, you see a rebalancing away from some of the tech sectors, equal-weighted S&P doing better. On our side, we do specifically have that conversation with our clients because this is one of the angles, one of our strengths, offering that diversification benefit to our private and institutional clients.
You mentioned, this ties in obviously, but you mentioned the dollar a couple of times, and so we've obviously seen a strong Swiss franc on the back of that. Most of your costs are in the Swissy. Are you doing anything to mitigate that the strength in the Swiss franc?
This is a structural trend, right? Switzerland, and we are, as an investment manager, an export industry, so you're kind of born with that strengthening Swiss franc. So, of course, we're looking at it intently, and we're certainly not looking to extend the difference between how much is based in terms of our revenues in dollars versus cost. But what comes with it as well, certainly last year, and positions us strongly, is while it's challenging from a translational perspective, it's favorable from an operational perspective because it does lead to all those conversations that we want to be having with our clients, including with our US clients.
Crystal, can I ask about this efficiency project you've announced? Is that about short-term cost cutting, or is that about investing in technology which might save you money in the future? We've talked a lot about AI on this programme.
So this is efficiency program that we've announced actually in 2024. So we're running into the third and last year. 100 million project. We're really actually ahead of it. So 80 million at the end of last year. It was about first getting leaner, faster, but most importantly, embedding the cost discipline and increasing our efficiency. So that there's definitely the intent, and we have done that, to invest into our growth areas, and technology is of course a supporting element of that.
Crystal, thanks for bringing us the numbers and the insight. We really appreciate your time this morning. Crystal de Lint, Vontobel's Co-CEO. Thank you very much indeed. Coming up, a crisis of confidence in crypto.
A lot of people sold Bitcoin as being the next gold, and it turns out that in the face of doubts about stability, doubts about politics, the next gold turns out to be gold, not Bitcoin.
We're going to go big on Bitcoin next. More analysis coming up. This is Bloomberg.
Welcome back to the programme, 7:42 here in London. The futures picture then looks pretty flat, actually, for the overall market. Some real divergence, though. The FTSE 100 could be weaker. We are, of course, watching very volatile metals prices and commodity prices, and so that could have an impact. And some M&A falling apart, of course, M&A that was planned. Announced in session yesterday, but we'll see if that has another day to it. DAX futures, though, pointing a little bit higher, Guy.
Let's talk about some of the corporate news we've had over the last couple of days. Vestas out with numbers yesterday. The stock closing lower on Thursday. This after the Danish wind company said 2026 revenue could be a little bit softer than previously announced. The company also raised its dividend and announced a buyback. Why did the stock drop? Let's kind of talk a little bit more about this. The Vestas CEO, Henrik Andersen, joining us around the table. Good morning.
Good morning.
Stock was down quite hard yesterday. you sometimes get this volatility around earnings. I can't work out whether it was because the buyback wasn't big enough and people had anticipated more, still fairly substantial, or whether it was because of concern around services margins. What do you think?
Yeah, first of all, I think we actually had a very good year. Yep. We came out of a very good year, and if you have asked me the day before, and probably quite a lot of people around us, we would probably have not foreseen that was where we ended, and yeah, that's up to us.
Yep.
I think we are in a business where it's quarter after quarter, and as we also demonstrated last year, we don't like big splashes when it comes to capital structure. We set out now a policy that is revised for capital structure, where we will reallocate more of our cash flow back to shareholders.
Yep.
And that will come gradually. So we have 4 quarters to go in the year, and therefore we start with 150 million euros.
Could that number go higher then?
There's cash enough. We have a cash balance end of 2025 of 1.2 billion. And of course, maybe some have looked at, said, could we have done more? Question here is, as we said, we like to distribute up to somewhere around minimum 40% of the net profit. Everyone can see that was not 100 million and 150 million, so therefore there's probably a question of when and who. And there we're saying, come on, we just want to be a regular buyback of shares.
Just on the services margin as well, what are your thoughts there? Does that get better?
I think the underlying business is getting better, but we also
building a lot offshore at the moment.
No, we are building a lot around the world, and as I said, the busiest quarter we have had, fourth quarter. So, in some ways, the business is high activity, and we are halfway through what we call the service recovery, and I will say, great progress. Still a little concerned of that we shouldn't release anything on P&L side. So let people continue to do the proper recovery on the service side, and then on the onshore, on the offshore, really pleased to see the progress.
Henrik, you had, 16 gigawatts, a little over 16 gigawatts of orders in 2025. What's the order book looking like for this year? How much above that level do you get, do you think?
Yeah, I don't think we are normally the ones where sort of a little luxury compared to many other industries. We are covered from an order book in year because there's typically a 35-40 weeks lead time into getting it to site, getting it commissioned. So therefore, when I look into a year like this, a bit more concerned about, is there some stop and go in border crossing, or is there some stop and go for weather reasons or something? So otherwise, we have a pretty good and high transparency on a year like we are entering into. And then, of course, this year, from a commercial point, all about filling both the offshore longer out and onshore 27 and 28.
Talk to us about the US market. You've gone from a situation where there was policy certainty with the Inflation Reduction Act under Joe Biden to an administration that has a lot of animus towards the wind industry. How is that changing your strategy for the US market? How much are you prepared to commit to that market? Is it becoming less investable?
No, I think we have been there. I mean, we have factories there. We have been there with factories for more than 2 decades. And I think always here, energy is a little bit in the category of defense. Pendulum sometimes swings, but overall we need to find a middle ground of that, which has also been the case in previous administrations, and this administration have had one time before. When we come up towards 28 and 29, we will see some of the tax incentives changing. And I think right now it seems like the underlying energy price in the US is actually pretty much demanding more capacity being built fast. So for us, I think it will work. And customers in general see it will work.
Is that a data center story, that demand?
I think it's a twofold, because the data centers, we all talk about data centers, inflated topic as I call it, but it's true. We are building it, it's there, it's coming, but I think also the other sides, one shouldn't underestimate that now for at least 4 to 6 years we have said relocate, made back in America. And if we look at our locations and facilities in the US, they have been expanded over time in the last 5-8 years. So therefore, I think that also drive an energy demand in the US.
Yeah. Henrik, so putting all that together and your stance on the States, are you looking to lean into more US investment, or do you keep your plans as they are, no change?
A little bit the answer is the same as here. We never run capacity expansions just by thought or positive CEO feeling. We run it by what comes in tangible in an order backlog. So when we can see our order backlog increases and become longer, that's where we then consider using and expanding the capacity. And let's not forget, it's only a couple of quarters, I said here, where we were still ramping up to full capacity in the US. Yeah. And our deliveries in 25 in the US went up with more than 60%. So we're actually pretty pleased with where we are right now.
What are conversations, when you talk to the administration in the States, what do those conversations look like? I mean, the view, President Trump's view is well known, and we see the impact of that, and it goes through the courts for some of your customers. But I wonder, you know, he's also somebody who sometimes changes his mind, and there's a lot of demand for energy, for data centres and other things, risking pushing prices of energy up for other customers. Is there a sense that there is an argument to be made there?
I don't know if there's an argument to be made. I try not to go there, because I think the argument today seems to be a bit counterintuitive in most part of the world. I think I like to talk about energy facts, because if we see it, the whole world, the societies in a decentralized world as we are seeing, all requires more electricity. Whatever we use, we can look at our home base, we have iPads, television, cars, transport. So the electrification is happening across the globe. That drives an underlying demand for electricity. And of course, for us, come on, there is an electricity demand. Yeah. Go outside this morning, you'll see the wind is blowing, and it will blow again tomorrow.
So will the US use increasing amounts of wind, despite the politics?
I don't know if it will necessarily increase the wind, but it will take advantage of that it's an energy source that is available, and it is affordable. And that's the whole point here. People are also looking at saying, how does that look 20 years from now? And you just had a very successful AR7 here. For exactly the same reason, you can build a capacity that is probably 30-40% cheaper than building another gas facility in price comparison.
What did you mean when you say data centers are overinflated?
No, but I just, as I said, listen. I was yesterday morning. I came on a similar morning show with a CNBC, and I was asked on a topic, and I burst into laughter because somebody said to me, "What do you think about this new thing that we could build a data center in space?" And I said, "Do you know what? Maybe it's just me. Maybe I'm born too early or whatever." Because I'm sort of saying we got a lot of things to take care of on the street and the earth right now. So maybe sort that out first, then we can start playing with the next thing.
There's plenty of sun. Not sure about the wind up there. Henrik, thank you very much. Henrik Andersen, the Vestas CEO. Thank you for joining us. Let's get Stocks to Watch with Jennifer Creary.
Good morning. We got another big day of earnings, and we start with Sabadell. Sabadell announcing fourth quarter earnings, but also an €800 million buyback starting next week. But perhaps overshadowing all of that is the announcement that we got last night that the CEO, Cesar González-Bueno, will be leaving the bank. He'll be replaced by the UK head, Mark Armengol. Of course, this comes just months after Sabadell defended itself against a hostile bid from rival BBVA. So perhaps those shares will be moving at the open. Next up, we're going to flip over to another set of results, and that's from the French lender SocGen. SocGen announcing a €1.5 billion buyback program and also a beat on fourth quarter earnings. Of course, this all comes in the context of the French lender cutting costs, cutting hundreds of jobs and selling assets. So let's see if that buyback program is enough to keep investors happy at the market open. Finally, we're ending on Stellantis. Of course, the company announcing that it's taking roughly €200 billion in charges. That comes as it overhauls its operations, and it also faces weaker electric vehicles sales. Of course, it's not the only car maker that's announcing similar write-downs. Ford, General Motors as well announcing similar measures. So those shares definitely could move on the open. Back to you.
Jennifer, thank you very much. Jennifer Creary. We're watching geopolitics. We're heading into the weekend. Iran and the United States are talking in Oman, and we've heard from the semi-official news agency in Iran, that's Tasnim, that the conversations have started. Oil prices are up 1% or so. The Iranians playing down the progress they expect to make here.
Oil prices are continuing to climb. Which is interesting. So, yeah, Brent's up 1.25% this morning. How does the market react? What's the market position for? Is it positioned for this to go nowhere, or is the market position for something to happen here, or is the market position for nothing to happen here and therefore there to be military action? there's some premium priced in, but I don't know how much.
One of the worst case scenarios for trade and oil would be the closure of the Straits of Hormuz, and we have a story today about tankers speeding through that choke point right now on those tensions. So already freight are making some decisions to kind of get through there pretty quickly. But this is something we're watching and monitoring. And as you say, the movements, oil has been volatile, and now it's up 1.3%.
Yeah, the Iranians saying today that these negotiations could be the first stage of a longer diplomatic process. So there's a sense that this, at least from the Iranian side, that seems to be the message they're trying to get out there, that this isn't going to be something that is done and dusted today or into the weekend, that this is something that drags on.
But there's also reports of a kind of growing concern again on the streets as to what happened, and a kind of another reaction to how hard the authorities have been obviously pushed down the first set of protests. So that story hasn't gone away either.
Yeah, and is that on President Trump's mind, or is it very much the possibility of doing some sort of nuclear deal? Because both of those things have been cited.
Yeah, on the human factor, I mean, there's reports of 30,000 people massacred by the Iranian authorities, but the reporting out of the White House seems to suggest that they are very much focused on the nuclear program rather than alleviating the concerns of the people on the ground in Iran. But we'll see how that evolves.
Absolutely. OK, we are coming up to a market open that looks like it's going to be fairly flat here in Europe. US futures continue to be soft on the other side of the Atlantic, so we're going to bear that in mind when we think about what is going to happen with the tech story. Keep an eye on the autos this morning. Big charge being taken by Stellantis. That could be a standout feature this morning. The market is 5 minutes away. This is Bloomberg. Welcome back. A couple of minutes to go until the final session of the week. The opening trade almost upon us. This was yesterday's session stateside. Really choppy. Number of things colliding yesterday in this market. The selling of the software continued. You've got the labour market data, which is still not looking that pretty. That's a factor. Certainly that got rolled into yesterday's session. We're waiting for the payroll data, the official payroll data. Obviously, that's going to come next week. So really choppy session. The Nasdaq obviously was under more pressure, and we've had Amazon overnight as well to fold into the narrative. US futures are currently negative. So all of that still needs to be priced in. So the back end of the session kind of continuing, and then we get a drop in futures, Tom, into the European start of the day.
Yeah, Nasdaq 100 futures, Nasdaq 100 now down about 3% year to date. European markets were down by about 1% on the close yesterday. Banks really taking a big hit as a sector. Interestingly, tech actually performed in Europe relatively well. But we'll see how that story, of course, evolves today. The capex spend from those big tech companies stateside, $650 billion total for 2026. Will that give a lift ultimately to some of the suppliers around the AI story? European futures currently flat. FTSE 100 futures down 0.6. We're watching the mining space, of course, on the back of the Glencore and Rio deal coming apart. DAX futures pointing the gains of 0.3%. So the German picture looking a little brighter, Anna.
Let's talk about some of the stocks and sectors in focus. The car makers will be Stellantis in focus. They're taking a charge, 22 billion euros, resetting the EV business, facing higher cost, muted EV sales. Of course, that's the theme there. Watching the banking sector, Sabadell front and centre. We spoke about the handover of the leadership of that business, the TSB sale. We'll watch that one at the start of trade. And SocGen unveiling a buyback, profits beating. We had profits missing over at Orsted in the wind sector, but they're reinstating their dividend. We'll see what that does to the share price. Guy.
A lot to fold into this session. Let's get it going. It's time for the opening trade. This is what the early numbers look like. We're expecting the FTSE 100 to be under a little bit more pressure than most this morning. It opens in the red. It's down by 0.2%. We'll wait and see exactly what happens with the oil price today. That could be critical for the London market. But you've also got a gilt story that we're going to get to in just a moment as well. Stock 600 fairly flat as we open up for trade this Friday across Europe. It's going to be interesting to see what the CAC does, the DAX, the SMI. The DAX on the auto sector story. I know Stellantis isn't there, but it's going to be something that we're going to watch out for very carefully. The IBEX is down by 0.5%. The banking sector front and centre there as well. We'll give the CAC just a second to see if it opens. Looks like it could take a little longer maybe to get it going this morning. That could be a Stellantis story. We'll come back to that in just a moment. Tom, what do you got on sectors?
Top sectors right now: construction up 0.8%. Energy, to your point about oil, up 0.7%. Brent is currently up 1.1% at $68 a barrel. We watch, of course, the talks that are underway between the Iranians and the US. So energy is there. Utilities up just 0.1%. On the downside, biggest losses coming through. Basic resources, we kind of saw this one coming given the pressure on iron ore and also the breakdown of the deal between Glencore and Rio Tinto. Currently down 1.1%. Basic resources off, and financial services as well. We've got the Anthropic news in terms of a further update there. Financial services down 0.7%, Anna.
I'm interested in the move higher in the construction sector. Vows is a big mover there, up by 5.4%. And this was a story that started yesterday, really. We had some of the infrastructure companies in Europe doing really well, benefiting from the data center story. So again, this is another sort of incongruity of the markets, that we can celebrate those companies that are set to benefit from the data center build out, such as Vows, up by nearly 5% this morning. And at the same time, we can worry about all that spend on data centers over in the United States. I'm not sure if those two things fit together, but that's where we are right now, it seems, on markets.
I'm still waiting for a price on Stellantis. It is yet to open. The expectation is that it is going to be softer on the back of what we are seeing. In terms of what the biggest percentage drop is this morning, it's Sabadell. Which is interesting. An interesting time to exit the business, you could argue, for the current CEO handing over to the new one. But Sabadell is down circa 6% on the back of what we've seen this morning. Yeah,
really interesting conversation about AI being the future there, but at the same time,
not my future.
Yeah, handing over to new leadership. And we got a price on the TSB from our conversation, didn't we? The price
3.3 billion euros.
Yes,
Yeah,
so
what was the price?
Maybe new information to the markets. Just digesting it this morning. Let us talk about where we are in these markets in a bit more detail. It's been a busy week. Let's talk to Madison Fowler, JP Morgan Private Bank Global Investment Strategist, who's with us this Friday. Madison, good morning to you. Taking a while for things to settle down this morning. The London market underperforms a little bit. Stock 600 actually down now by around 0.3%. Nasdaq futures down 0.6%. So a sense that we're still in this slightly nervous environment where we're asking a lot of questions of tech and asking a lot of questions of the themes that have done well around metals as well. As we go further into February, Madison, how are you thinking about the investment climate at the moment?
So I do think that, as we've experienced these first 5 weeks of the year, there's been a sense of recalibration and a testing of investor resolve. And there's certainly been an amalgamation of risks that we've faced, whether that's geopolitical tensions, questioning around, the sustainability of AI spending and disruption around business models, central bank divergence, questions around growth. So there's certainly a lot to, I think, latch onto and create a sense of worry. But I do think that's why when we put together our year ahead outlook, it was called both promise and pressure, which is I think a cognizance and a realization that there are challenges and there are pressure points, and we need to be aware of them as investors. But at the same time, some of those challenges are also opening up a lot of opportunities, especially for active managers. And so I would say that the punchline is that we are constructive but not complacent to the risks.
Okay, so if you're constructive, which of these do you not buy into then? Coming out of big tech because we're worried about capex, coming out of software because we're worried about software, coming out of gold and precious metals, silver and the like, because they've just gone up too far. I mean, do you like any of those things despite the volatility we've seen this week?
I do. So I think what we're looking at right now is kind of a flush out around some of the worries when you had, I think, really a two-part problem, especially when it came to tech. One was the question around the monetization timeline around all this big tech spending. And the second thing was the more recent questions around business model risk and disruption risk. And so I think that some of that was probably necessary just from an investor discernment standpoint. And I think that that level of scrutiny is actually a healthy thing. I do think when it comes to tech, what we want to be focused on is who are the companies that are producing high quality earnings growth and who is showing that they have the propensity to monetize that. And then when it comes to commodities, I do think that there is, again, a flush out of some of that speculative buying. But when it comes to gold in particular, I think that remains a really crucial diversifier for us in portfolios, given the fact that we think that all of the structural dynamics are there, not just from a uncertainty risk premium, but also from structural central bank buying and the fact that retail activity does not look stretched at present.
How are you starting to factor in some of the expected updates that come through from the Anthropics and the OpenAIs of the world? So Anthropic with this new model that's targeting financial services, the London Stock Exchange Group is down about 17% year to date. It's down about 5% today. We don't have to focus on a single name, but we can expect more updates from these big models as they lead up to their IPOs. How do you strategize around that? How do you invest around that story?
And I think this is where the active management conversation comes in as well. Again, because our call has always been to invest across the entire AI value chain. So a sense of diversification as a result of some of this disruption. I would also just signpost that this process of creative disruption is commonplace throughout history. So, for instance,
is this an overreaction of what we're seeing right now for names like the London Stock Exchange and others that face this upcoming threat? Do you see this as an overreaction, as it may be a buying opportunity?
I wouldn't necessarily say it's an overreaction. I think it's a sense of market scrutiny of figuring out which companies can provide that longer-standing, high-quality profitability. And I think that through that level of questioning, there are some companies that are quality companies that might get hit in the process, and that's where the active managers step in. But I do think that this also, again, signifies that creative disruption is relentless in this type of environment.
You think active managers can pick winners in the tech space at the moment?
I do. I think that when there's more dispersion, that opens up further opportunities for active managers. But at the same time, of course, you're not going to get every call right. But I do think if you're focusing on those areas, for instance, that are more, if you're just talking about the software space, horizontally integrated versus vertically integrated, and so they have more deep competitive moats as opposed to being more AI wrappers, then that, I think, is a more prudent place to be when you're trying to position within the AI space.
Active has had a really tough time. It's not great. It hasn't had a great track record recently over the last few years of outperforming the index. Is this going to be the year? It sounds like you're suggesting that this is going to be the year in which active outperforms index.
So I think the last few years you didn't have the best setup for active managers. To your point, you had interest rates that were quite low, which made it difficult to even earn a return on cash if you're a hedge fund manager. And then at the same time, you had higher correlation, less dispersion. And so when we think about active management, that kind of alpha winter that we were feeling over the last few years, I think has certainly shifted quite a bit. But I would just stress there is huge dispersion between even active managers, and so that's why that manager selection conversation is really important.
We've seen big moves in the auto sector this morning, Madison, distracted by a 14% drop in Stellantis, for example. There was a sense some time ago that maybe the auto sector was drawing a line in the sand, that it could bounce off, that it had restructured a little bit. This sector for you still troubled? I mean, this is to do with rising costs and EVs not living up to expectation in terms of the sales numbers. What do you think of the sector as a whole?
I think it's still finding its footing and finding its way, because not only are there the issues that you called out, but there's also I think large change within the competitive landscape between, for instance, Europe and China. Exactly, and then in addition to that, you've had a number of years of manufacturing malaise within Germany, and we are actually starting to see the inflection points of that moving higher. So I think there's a case to be made for stabilization, but our areas of focus when it comes to cyclical sector exposure are more in the security theme of industrials.
In terms of what happens next, I hear a lot about diversification. Is diversification going to allow me to outperform this year, or is it going to continue to be an underperforming strategy because there are going to be core areas of the market that do better than others? Over the last few years, if you've diversified, you've underperformed because big tech has done well. Is that era now over? Is diversification no longer a losing strategy? And does it matter what I diversify into? How broad does my diversification need to be?
It, of course, matters what you diversify into. And I think at the same time, what I would say is with any diversification strategy, the aim is not to be the top performing asset, because ultimately
you can't be.
You can't be. That's just how the math works out. And so when I think about diversification, I think that I want to be prepared for a range of different scenarios. So I want to be positioning for upside in our base case, which means an allocation towards equities broadly. To your point on concentration risk, we are starting to see the earnings growth gap narrow between the Magnificent Seven and the rest of everything else. But at the same time, thinking about the other scenarios, fixed income offers you carry. Elevated yields also means that in a downturn, bonds protect you. But then in a volatile,
are we sure about that? Are the bonds going to protect us? Because they seem to over the last few days. And is that trade back?
I think that fixed income can offer you carry in the type of environment that we are in. And I think in a scenario in which you see a global growth downturn, yes, we would expect that bond yields would fall and protect investors in that type of environment. But if you were to see an environment in which inflation is structurally higher and more volatile, which is also something that we think will take place over the course of the next 10 to 15 years, bonds might not be enough, which is why we're very much focused on commodities like gold, real assets like infrastructure, and also hedge funds for uncorrelated returns.
Guys like a Roman centurion looking for a shield. It's like,
but that's what everybody's looking for at the moment. They're trying to figure out. There's been a rotation out of tech into
gold's going to work. Oh, hang on, maybe not. Gold is going to work.
Any other ideas? Bitcoin.
There's been a big conversation about diversifying into Chinese tech because of valuations. Well, HS Tech, that index has fallen 20% now from October.
It's a bear market.
So it's into a bear market. So what happened to that? What happened to that trade?
Diversify? Yeah, precisely. All these things. This is the challenge that everybody's facing at the moment. Is that all of the things that we thought were going to be diversifiers are now seeing massive volatility. So how is the diversification strategy working?
Sure. So I think, for starters, we are shifting into a little bit more of a volatile environment. Yep. In any given year, volatility is to be expected. The average, S&P 500 year sees a drawdown of 14.5%, but the average calendar year is still up 75% of the time. So I think that makes the case for staying invested. When it comes to where to diversify, I think different areas of the market provide exposure to different things. So gold can be a diversifier in the sense that it can act as an inflation hedge. It can be an uncorrelated asset. When you're talking about China tech, that's a growth story. So that's a little bit different. You want to be exposed to the competition between U.S. and China. And I also think that within that, you're positioning for an environment where, China as a broad economy might not be on its, upswing just yet, but China tech offers opportunity.
Yeah. Madison, quickly, before we...
Sorry, it's the correlations that matter.
Yes, the correlations. Yeah. I wonder what the correlations are between the politics of the UK and what's happening in the gilt markets and UK assets. Do we start to price in? Should investors start to price in more risk premium? Do you expect that to be priced in on the threats around the Prime Minister Keir Starmer and his political position?
I have seen, bond markets over the course of the last few years certainly react to political uncertainty. And it's not just a UK phenomenon. And we've seen it in the US, we've seen it in Japan, we've seen it in France. And a lot of that happens on the longer end of the yield curve. So that element of uncertainty, whether it's from a political catalyst, whether it's from fiscal and debt issues, whether it's from, geopolitics, that tends to happen on the longer end of the curve, which is why you've seen, 30-year yields rise.
Are you worried about the UK?
I think that the UK, from a growth perspective, has certainly had more of a mixed run over the course of the last few years. When we look forward, I do think that there has been a shift towards more fiscal conservatism, which we certainly saw that markets reacted positively to in the last budget. But I do think that, like the conversation for any economy, they're trying to solve the productivity problem. And I think that's something the UK is focused on, too.
Great to see you. Thanks for stopping by to see us. Busy morning. Busy week. Madison Fowler, Global Investment Strategist at JP Morgan, private to bank. Core 6 looks like this morning. This is where we're seeing some of the action. Chips are down. The ASML story is there, down 0.6%. Luxury is also not having a great morning. Defence is bouncing back. Rheinmetall had a tough day yesterday. You're seeking a little safety maybe in Nestlé. Down in Vevey this morning, up 0.6%. If you're looking for the biggest points drags this morning, these are they. Stellantis, SocGen, and interestingly, Danone is down as well when I bring up that Nestlé story. But let's start with SocGen with Jennifer Creary.
Right, we're having a look at SocGen today, really slumping on the open. That's despite the French lender announcing a beat on fourth quarter earnings, but probably not enough to assuage investor concerns over some of its cost-cutting measures, including cutting jobs and selling assets. Those shares are down on the open. Next up, we're moving over to Sabadell. Sabadell falling as well, 3.6%. Of course, that comes after the news that the CEO is leaving the bank. He's being replaced. But also fourth quarter earnings coming out, probably not enough again to boost investor confidence. Next up, we're flipping over to Rio Tinto. The big news coming out yesterday that Rio Tinto and Glencore talks have fallen through to create the world's largest mining company. Those shares really getting hammered in the open. And also we've got Stellantis as well, the car maker falling double digits this morning. That's after it announced it was taking 200 billion euros in write-downs as it struggles with weaker EV sales and higher costs. Next up, we've also got Lotus Bakeries. Lotus Bakeries full-year earnings beat analyst estimates. Those shares rising on the open, rising more than 2% off of the back of that. Back to you.
Cakes and waffles, gingerbread, cookies and snacks. Apparently, that's what they make. That's just got me ready for a second breakfast, I think it would be at this point, Tom.
Yeah, nice timing. Thanks for that. Now just focused on my hunger.
Got to have two breakfasts.
It's a double breakfast. It's a double breakfast Friday.
On a Friday, for sure.
Right, Jennifer Crew, thank you very much indeed. Coming up, talks to create the world's largest mine. How do I segue from double breakfast to the largest mining company and talks they're collapsing? What would have been the largest mining company? We're going to take a look at where that leaves Rio Tinto and Glencore. The backstory to this and the Bloomberg reporting has been fascinating. It's well worth a read. The wider industry. We're going to get the details next. This is Bloomberg.
Welcome back. 8:19 here in London, Friday the 6th of February. We made it to Friday, everybody. And the Stoxx 600 in Europe is down by 0.1%. The DAX is pretty flat. The CAC 40 and the FTSE 100 actually both kind of on a par, down by around 0.3%. Real weakness coming through in the auto sector because of the Stellantis story. And basic resources, once again, an area of weakness. Yesterday we saw Glencore down substantially within that sector. But once again, we've got basic resources on the back foot. Guy.
Let's talk about what is happening. We're going to talk metals. We're going to do it in two different ways. The first thing we're going to do is talk about what is happening with the company story. Merger talks between Glencore and Rio collapsing after the two companies failed to agree on a price, or Glencore failed to agree on a price, but I guess it takes two to tango. The deal would have created the world's largest mining company. What happens now? Let's find out. Martin Ritchie joins us, our metals and mining reporter. They keep trying and it keeps not working. Why does it keep not working?
Yes, they have been trying or talking about combining these two companies for a long time, and it went right down to the wire yesterday. There was a deadline for them to extend talks, but it looks like just ahead of that they decided this wasn't going to work. Glencore, according to our reporting, at least demanding at least a 40% share of the combined company, and this just wasn't going to fly with Rio Tinto. It's an interesting combination because on the one hand, Rio really wants more copper. It's a very experienced mining company, both in building mines and operating mines. Glencore has got very good assets, especially in Latin America, but they're not. A lot of them aren't developed yet. They're future assets. They give optionality for the future, and so bringing the two companies together was supposed to kind of unlock all that value over the future. I think the sticking point is really that Glencore is wanting a sort of a hefty valuation right now for that optionality that lies well in the future, whereas Rio Tinto, possibly with an eye on its existing shareholders, not so willing to come up for that kind of short-term deal. So it could still happen. They can still start talking again in the future, but for now, it's again delayed, and it points to the kind of difficulties of these big merger transactions that the mining companies are trying to do.
Well, on that point then, Martin, does this open the door? Is there a view that BHP could now make a play for Glencore?
It's the obvious thing that people are discussing. BHP obviously also wants a big copper deal. It's tried last year with the attempt to take over Anglo American, which also ended up with BHP backing off. The problem here is it's the obvious suitor, but the problem is if Rio has backed away, then BHP's shareholders would be saying, well, why would we be able to pay that kind of valuation as well? and it's a complex transaction, which BHP walked away from another sort of difficult, layered transaction last year. So again, it doesn't seem like straightforward, certainly, and it would be, I guess, on the surprising side if they were to do that.
Martin, we've talked before about how your presence on TV often indicates there's something exciting happening with precious metals. There has been. I can see that silver is actually up by 3.6%, which is pretty tame for silver these days, but it was down by 10 during the Asia session, wasn't it? I mean, what is happening? What is the latest news driver?
Let me be frank and ignore that tiny little move up for silver today, because what we've seen really in context in the last few days is a kind of sell-off across metals, both base metals and precious. They've come down from really elevated levels. We had that whole kind of manic trading around the world, people buying into metals here in China, a lot of trading interest, and I think that some of the air has come out of that balloon, as it were, and we're starting to come back down to earth a bit, and it's certainly on say copper or silver. A lot of analysts are saying, the valuations previously were really too high, but perhaps in gold there may be a sense that this is a dip that some analysts say is maybe an opportunity to buy some of those structural drivers for gold, for example, central bank buying, weaker dollar, etc., may still be in place in the coming year.
Okay. Martin Ritchie, Bloomberg's very own lagging or leading indicator when it comes to precious metals, also our mining reporter. Thank you, Martin, for that update. Let's get to what's happening, talking of volatility, in Bitcoin, bouncing back after falling to a fresh low of $60,000 in a volatile trading session. The cryptocurrency slumping to more than half its value from those all-time highs in October. Let's bring in our senior editor for digital currencies, Ana Herrera. Anna, what's going on? What are the factors leading to the downside for Bitcoin? Help us understand what's at play here.
It's hard to know with Bitcoin, as usual. So obviously, one of the big things we've been talking about that's very different is that the environment seems to be supportive compared to other times, right? Like in general, right? We haven't seen big exchanges crash. Regulation is okay. But obviously, Bitcoin being Bitcoin, it acts in ways that are very hard to determine for us normal humans. One of the things that we've noticed is that there's been a sort of lack of a clear narrative. For years we thought Bitcoin was digital gold, was a hedge against inflation. It's really not behaved in those ways. It's more behaving like a risk asset, which probably it is, right? So it fell when other tech stocks were falling, and now it's bouncing back a bit. We've been told it's because 60,000 is a key level. And one of the reasons why it's cascading and falling very quickly is because crypto exchanges have this mechanism where margin positions get liquidated after they hit certain thresholds. So the more it falls, the more it falls. And liquidity has been thin since October when we had a big crash, which means that moves are even more pronounced than usual.
How are we feeling about Michael Saylor?
I mean, we should ask how he's feeling. I mean, one thing with crypto is that people that bought early and that are believers, it's still very much an ideological asset. I think
he's underwater now.
Yeah,
so is family Trump, right? Who've tried to cash in on this whole thing.
So I've been covering this asset for like 13 years, 15 years. So it's quick to think, oh, they're done. It's going to spiral quickly. We went from 70 to 60, and then they always bounce back. So I think maybe that's what they'd answer is like, wait, we'll talk again in a year.
Yeah. Anna, thank you very much. Anna Herrera with the latest on the trends in cryptocurrencies. More on the markets when we come back. This is Bloomberg.
Good morning. This is the opening trade. Welcome back. We are 30 minutes into today's session. You're seeing European stocks down 0.3% after losses of around 1% yesterday. We're focusing on the auto sector, the biggest losses coming through there. That is weighing on the CAC current over in France, with Stellantis tumbling on the back of a change around its plans on EVs. Down 0.5% on that benchmark over in France. The DAX in Germany down 29 points. Here in the UK, the FTSE 100 down 0.4%, and across the benchmark, losses of 0.3. It's the earnings story. It's the tech story. Guy, what are you seeing?
2 to 1 down. That's the ratio. 194 up. 395 down. Volume is actually reasonable. There's a lot of earnings to price in. There's obviously the kind of the structural story. There's the tech story. There's all kinds of other factors we need to fold into these markets as well. So that's the kind of internal picture. Single stocks, let's talk about where we are leading. Vinci is up. EBIT beat. The numbers look good. Novo is bouncing back as well, up by 4.83%. It got hit hard earlier on this week on copycat therapies around weight loss pills. Orsted is also up on the back of its numbers this morning. That's where the gainers are coming through this morning. Reasonably eclectic mix on the upside. The downside is really interesting. Stellantis taking a huge charge relating to EV, getting absolutely battered this morning. The stock is down by nearly 20% on Stellantis this morning. This is one of the world's biggest car companies, has just lost 20% of its value. SocGen is down by 2.83%. Those two stocks really weighing on the French market. But I'm going to add another one in as well. Danone is down 2.51%. The reason for that, we are back to the baby milk story and what is happening there. That is a stock that is under pressure as a result of what is going on there. It's interesting that Nestle is actually tracking a little higher this morning, but French stocks, Stellantis, SocGen and Danone, all under pressure this morning, Anna.
Guy, let's get an update on some of the other political news flow we need to be aware of this morning. Japanese voters go to the polls on Sunday for a lower house election that's a high-stakes gamble for Prime Minister Sanae Takaichi. She's seeking to shore up her coalition's majority in a vote set to have wide-ranging implications for markets and regional security. The U.S. virtual embassy in Iran has issued a security alert urging American citizens to leave Iran now and not rely on the U.S. government's help to do so. It comes ahead of planned talks in Oman due to take place today between Iran and the United States. Iran said the negotiations could be the first stage of a longer diplomatic process, signaling there won't be a quick resolution to escalating tensions with the United States. Bloomberg has calculated that the four biggest U.S. tech companies are planning to spend $650 billion on capital expenditure just this year. Each of those companies' estimated outlays would set a high watermark for capital spending by any single corporation in any of the past 10 years. An incredible uplift year on year. And once again, capital expenditure to the fore then, Tom.
Yeah, and sticking with that theme then, Amazon shares slumping after the company announced plans to spend $200 billion this year on data centers, chips and other equipment.
When I look at this, what's happening, it's kind of unbelievable if you look at the demand of what you're seeing already with AI. But the lion's share of that demand is still yet to come in the middle of that barbell, and that will come over time.
Let's bring in Matt Bloxham, Bloomberg Intelligence senior analyst. So we saw the shares selling off under pressure on the back of this. $200 billion on CapEx. So beating, at least in terms of their forecasts, in terms of what they plan to spend, coming in much higher than many of the other big tech companies so far. They have $250 billion in terms of a sales backlog. So why are investors so concerned?
Because that sales backlog will probably play out over a number of years, and a lot of this investment, if you think about chips and the pace at which NVIDIA and others come out with the next generation of their technology, how quickly do you need to amortize those chips before you're investing another tens of billions of dollars in the next technology? So some of this investment is going into long duration physical infrastructure like the data centers and the power to deliver it, but a lot of it is going into that kind of much shorter duration technology. And I think people just don't know what the kind of the mismatch is between that investment and the pace at which revenue is coming in.
It's so weird. There's two stories. There's the kind of we're spending too much on AI, and then there's the AI is going to change everything narrative. Both seem to be represented this week and current and having an impact. And Anthropic is the kind of the latter story. Earlier on this week, it was going to become my lawyer. Now it's going to become my financial advisor and my financial analyst. How significant is this?
It is pretty significant, and obviously, those two truths kind of coexist. That we're spending too much, and AI is going to change everything. And we've seen that kind of cycle before. Companies spend too much because their competitors are spending too much. And they all have to just kind of do it. Otherwise, it's a kind of mission critical risk for your business. Anthropic's taken a very different path to OpenAI and Google in the focus of their technology. Made it much more about being an enterprise, robust bust product and looking at specific verticals within that and making a product that really kind of stands up to the kind of tests of kind of day-to-day use, and obviously the financial markets and not just investors and analysts, but anybody working in a company that's like kind of got an analytical or financial kind of role. It's a hugely complex task and very well suited to the kind of things you can do with AI. And so they've kind of really found a sweet spot for that and are kind of doubling down on their investments there. They've got something like 300,000 enterprise customers. The feedback is really good. Even Microsoft has integrated this into Excel, the most popular productivity software on the planet, and it's more popular than their Copilot.
Yeah, and that goes to the question we can't answer right now. To what extent are these competitors versus sort of a symbiotic relationship between software companies and the likes of Anthropic making these AI tools? Matt Bloxham, thank you very much. Matt Bloxham, Bloomberg Intelligence senior analyst. Now, sticking with this theme, we spoke to our guests this week about the software slump and the shifting impact of AI.
Nobody is vibe coding their payroll. That is a future we're not going to live in. The market has overreacted to the perception that vibe coding is going to cause enterprises to rip and replace their SaaS spend. They're just not.
If we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change.
The impact of technology and AI to our society, to our business is going to be very profound, and I wouldn't say that the market is overvaluating that, but from a financial standpoint of view, I do believe that there is some reconciliations to be done.
The transformative power in this is very substantive.
For the good or for the bad?
Well, I think for the good and the bad, but I think AI needs to be regulated.
So it's powering AI from grid to core. That's where we see tremendous growth potential. It's going up quarter after quarter. It's for us the biggest growth driver in the history of the company.
Using AI will help us to invest cheaper and have a better outcome.
With lower headcount.
Exactly. Less hiring or effectively and increasing the revenues faster.
AI has an impact, yes. We are still not, and many others are not able to measure that precisely, but there's a lot of automation. And again, one transformation is about aligning common business models, having common tech platforms at scale.
So many interesting conversations attacking AI from different directions. Let's focus in on the software story. We are joined now by Anwiti Bahaguna, Global Co-Chief Investment Officer at Northern Trust Asset Management. Anwiti, nice to speak to you this morning. So, I mean, the story of this week, or the news story around AI this week, has been around software, what Anthropic is doing, these plugins, and what they can do to all kinds of white-collar parts of the economy. What is the context around that software story that you think is important as we think about how substantial a shake-up this could be?
Sure. First, thank you for having me. Yes, this week has been about Anthropic and the impact on the software industry from a very macro perspective, which is sort of where I am most of the time. This is sort of the disruption we were waiting for. All of last year was, why are we spending so much money? Why are we doing so much capital spending? What is it having an impact on? And now with the coding news, the replacement of analysts, hopefully not all of us, the news is really beginning to show us that it is disruptive. It will change the dynamics in the economy. Not something to be afraid of, but there will be winners and losers. And for the first time this week, it's been about differentiating the winners from the losers.
You see that, do you? Differentiation? Because sometimes it looks kind of indiscriminate, or at least by a sector. There's a legal plug-in, sell anything that has a legal business. There's something to do with financial services, analytics, sell things that do that. Without asking, does this AI tool really replace or complement the things that these other companies produce?
It's been this indiscriminate, in my opinion. So what I have seen so far is that, very hard to say at this early stage if we know exactly who the winners are, exactly who the losers are. But we've seen companies with 45, 50% margins, really strong stream of billions and billions of dollars of earnings, absolutely smashed in valuations, halved in valuations, And I can see the differentiation, Anna, more on the macro level than on the micro level. In other words, you're right. There are many companies, good ones, that are being sold. The differentiation I'm seeing is really in stocks versus what's happening to the credit of that company. In other words, we're seeing the stock of a company valuation cut in half. But because the balance sheet is good, you're seeing their credits not blowing out. So there has been clearly a very small move in credit also, but nothing to the extent we have seen in the equity market. And I think that distinction is important because ultimately it's the bond market that gets it right.
It's interesting that you tie this to credit, and I just wonder how much confidence you have that story maintains. Or are we getting to a point where there's going to be a moment where people have to unwind their leverage and we get something that breaks? Are we getting closer to a point where something breaks?
So we have seen that in the credit store, in the credit market also, I'm talking about what I can see, which is in the public markets. You have seen the response in the companies which have that leverage you're talking about, which is predominantly in the private market. So because there we don't have the transparency on who owns what, how much software exposure do they have, what type of software exposure do they have in the venture space, in private equity, in private credit, that's where you're seeing the likes of some of the BDCs getting crushed. Because
so you're concerned about what's happening in the private.
I am concerned about what's happening in the private. But what I'm seeing is that I'm actually getting some confidence by looking at the actual credits, because some of this infrastructure spend and data center spend has been funded in the public markets also. And in the public markets, we're not seeing that bloodbath on the credit side. So that's giving us some hope that this is still not a contagion, not a thing that's spreading through the financial markets. It's limited to a reaction to this is happening. Let's now sharpen our pencils and look very carefully at which companies are going to win this and which companies are not.
How do you think sentiment is today versus a week ago versus 2 weeks ago?
Oh, it's absolutely short right now in the markets, right? And that's why, to Anna's point, you see so much indiscriminate spending. But this is where you need your active managers to go and say, this company has solid revenues over 3 years. They're not going to be decimated. Sure, there'll be some earnings.
Do you think they know? Do you think they have enough visibility to know the answers to that question?
On the public side, they do. And on the private side, you have to know your managers very well also. Not the companies per se, but your manager's ability to take those.
The pace of disruption is enormous. How can I predict what these companies are doing and what their revenues are going to be looking like and what their margins are going to be when things are changing as fast as they are in terms of demand for their services?
So that goes into how diversified and how I think your analyst was talking about how deeply embedded they are in their enterprise. So there are companies which are small players, which can be easily unplugged from your enterprise. And there are companies which are deeply embedded into your enterprise, which have more than one function for you, more than just the coding function.
Sure.
And those are likely to maintain their earnings. Sure, there will be a hit to those earnings. And right now, the companies are not quite sure, to your point.
Precisely, and we can quantify that at this point, can't we?
Not really, so that's why the valuation's getting crashed.
So, but active managers...
Active managers can. Good ones.
They can even with the volatility and the uncertainty at the moment, you're confident that they have the ability to...
I am fairly certain that's what the analysts do. That's what they look at 3 years out, not a week or two. And in a week and two, you'll see the managers just sell based on valuations.
They're armed with some new AI tools now as well, so maybe they can do it even better and even quicker. So that'll be great and witty.
With such conviction.
We've talked about de-dollarization and how that's either a theme or completely exaggerated or probably somewhere, some more nuanced picture in there. You are seeing some modest rise in hedging activity around that currency exposure. Tell us a little bit about that, what you're seeing and what you're not.
Sure. So this started again, Anna, last year, right? We saw a 10% decline in dollar versus its major trading partners. And then because of some of the geopolitics news coming from the U.S. this year in January, all of January, every weekend, we saw some prominent pension funds actually come out and say that they are withdrawing from their allocations to the U.S. markets. but those are very few anecdotes.
With symbolism.
So I would say yes, but I would say broadly we're not seeing massive outflow outside, foreign investors pulling out of the U.S. In the equity space, it's still 68% of the global industry.
Is hedging the FX more important than it was?
Hedging the FX was actually, very helpful to clients because they could see their equity allocations go down, and then if there was a sell-off like now, and dollar, benefits anytime there's a sell-off like that, their unhedged positions actually gave them better returns. But now equity investors are beginning to hedge again.
OK, how to hedge, how to find some defence in a volatile environment for the markets more broadly. Thank you very much indeed for the analysis, particularly with the lens on what's happening in the tech space. Anwiti Bahaguna, Global Co-Chief Investment Officer at Northern Trust Asset Management. Coming up, for how many, this is a tough one, for how many years has Minal Bathwal, a macro hedge fund manager at Brevin Howard, been on a winning run? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked, for how many years has Minal Bathwal, a macro hedge fund manager at Brevin Howard, been on a winning run? It's quite the winning streak, in fact, because the answer is 18 years. Bathwal has quietly become one of the world's most successful macro hedge fund managers and hasn't had a single down year since he started managing money during the 2008 financial crisis. The fund manager's winning run has secured him a place among the 5 biggest generators of investment profits in the history of Brevin Howard, a $35 billion hedge fund giant. Not a bad streak. Anna.
Some big numbers. Let's talk about what lies ahead for the weekend, and that's politics in Japan. Japanese voters go to the polls on Sunday for a lower house election that's a high-stakes gamble for Prime Minister Sanae Takaichi. She's seeking to shore up her coalition's majority in a vote set to have wide-ranging implications.
Just 3 months into the job, Prime Minister Sanae Takaichi dissolved Japan's lower house, calling a fresh vote for February 8th. Coming from a string of election setbacks for the ruling Liberal Democratic Party, Takaichi is aiming to capitalize on high public support and increase her majority in the more powerful lower house. Some recent polls show an approval rating of more than 60%.
I think Takaichi is really in an extremely enviable position. I mean, her support rates have been consistently extremely high, and I think that's going to do quite a lot for her in this election.
A stronger mandate would make it easier for Takaichi to push through her agenda, including higher defense spending and the largest supplemental budget since the pandemic. But the road to victory might not be straightforward. The LDP's alliance with Komeito fractured last year, ending a 26-year political partnership. The realignment injects new uncertainty into Japan's electoral dynamics. Voters, though, are more focused on the cost of living. Inflation has stayed above the Bank of Japan's 2% target for more than 3 years. The stakes are high. An increased majority would give Takaichi a green light to pursue what supporters call a more assertive Japan, with higher defense spending and state-led investment. But a loss of seats would be a self-inflicted wound for the new prime minister, who has said she would step down as party leader if that happens. Ariel Buzetto, Bloomberg, Tokyo.
What does it mean for Japanese equities? What does it mean for the BOJ? What does it mean for the yen? All critical factors as we work our way through this weekend. Joining us now, Bloomberg M Live's Adam Linton. What's the market set up for when it comes to Japan and this election?
I think ultimately, given the polling, I think the consensus now is that she will ultimately expand to a slim majority. And I think, for dollar-yen, I think what's been interesting is that we saw those rate checks a couple of weeks ago, and that knocked dollar-yen sharply lower. And at that point, I'm of the view that would have been the time to do intervention, because you could have easily sent dollar-yen into the 140s at some point. However, though, markets have kind of been cynical as to whether they actually follow through for the intervention, since Scott Bessent relatively cool on the prospect of joint intervention, and we've kind of risen 4 handles. So, there's a worse entry point for Japanese officials to intervene than they had done. And if, we do get another rate check after the election, if the yen does really start to sell off, I think the markets can be a lot more cynical as to whether they'll actually follow through an intervention. And also as well, they'll probably need a softer dollar in order to get the maximum bang for their buck. But, that opportunity does look as if it has potentially faded a bit, and they're leaving themselves a bit of a hostage to fortune. We're still awaiting US CPI data. If that comes in soft, yes, it could be back on the table. But, it's not a favourable setup for those who are looking to be short dollar-yen at the moment.
If we do get softer dollar, we can get a stronger euro. And euro strength has been there, and we've seen that be impacted the corporates, certainly in 2025. Christine Lagarde didn't seem to be too concerned about the strength of the euro yesterday. What stood out to you? How clear is the path ahead for the Eurozone, for the ECB, and whether or not there is going to have to be an FX take, at least, or maybe some kind of verbal jawboning of the single currency?
Yeah, I mean, she was definitely a lot less, cool on the idea than she could have been, because obviously, we were hit with like 120 last week, and that's, that's kind of a line in the sand that ECB officials have drawn because of those comments from Louis de Guindos last year. We've pulled back about, 2 handles since then, so there wasn't really that urgency for her to kind of say too much. And ultimately, euro-dollar, is decoupled from rate differentials, and even if they cut, there isn't really too much they can really do about it. But I would say as well, euro-dollar, it's a relatively crude way to assess the strength of a currency. Yeah. On the ECB website, they cover the nominal effective exchange rate, and that's not really showing anything that remarkable at the moment. So I don't think there's really much urgency at these levels for policymakers to step in.
Very briefly on the gilt markets, how much risk premium is priced in with the politics?
I think it's increasing yesterday. Today, I think we have kind of stabilised a bit. I think betting markets are positioning for Starmer to leave at some point, but there hasn't really been any follow through from some of the stories that we've seen early in the week. So I think that premium has receded, but I think ultimately we're headed for a steeper curve. We've had Danish Bank of England and politics risks.
Anna Linton, thank you very much indeed. Bloomberg M Live, of course. Here's what else to think about for this weekend then. Tuning in for the Winter Olympics. Do you watch the Winter Olympics or the rugby?
Because the rugby, it's a big weekend coming up. Fantastic.
Guy Johnson's a massive. I don't know if anyone missed
Guy Johnson's been getting messages about his passion for curling. This is a new revelation. This is news.
I think the curling final is on the 21st or something. But
don't pretend you don't know.
I do know.
I think it could be on this particular day.
The opening ceremony's tonight, isn't it? That's going to be great to watch.
Yeah.
You've got great rugby coming up. There was some last night. I'm putting my fingers in my ears because I don't want to know the result because...
Oh, I can't...
Wow, that's impressive.
Don't tell me.
That's impressive. You work in news, Guy. How can you avoid...
It was on the television last night downstairs. And I'm like, I've got to go to bed. I saw Dupont. He was looking pretty good. I'm a bit nervous. Anyway, there's Milan. We're waiting for the start of the Winter Olympics. It's the Super Bowl.
Is that the main stadium?
Yeah.
Big sporting event going on somewhere in America as well, I hear. Is it sport? Is it entertainment? Is it an advertising event? It seems to be all of
those things.
And a gaming event, increasingly.
And the halftime, apparently, the
halftime show is going to be amazing. You always want to watch that. The ads are always amazing as well.
We'll be asleep there, probably. But yes, we'll...
Stellantis, before we go.
Stellantis is down really hard. But what is interesting about Stellantis is that it's down nearly 20%, but it's dropping the same number of points as SAP and Roche, basically.
Yeah.
That's amazing. They're only down kind of circa 1%. Tells you something about the European auto industry. Anyway, the Pulse is up next. Have a fantastic weekend, everybody. This is Bloomberg.